So when I look at our portfolios over almost 30 years of investing, and I look at the different tools that we've used, I'd say that the biggest part of our wealth has been made on simply buying cheap securities and waiting for something to happen for them to be fairly valued and then selling them. Probably the second most lucrative area has been in the field of what I'll call arbitrage, so where we are buying one thing but offsetting it with another thing. And in some parts of our business, we actually layer one of those things on top of the straight long positions, which creates incremental kind of torque in the return in the portfolio. But it also, since the characteristics of the things I just mentioned, arbitrage type structures are indifferent to the market, or in fact can benefit from a weak market, sometimes they act as a hedge in the portfolio as well. And then the last part of our business, which is the most, I guess, aggressive, would be in short selling. So that used to be quite a lucrative business. There were times in Canada where there were large swaths of certain exchanges that were stock promotions and things that had no fundamental value to them. And you could make a lot of money by taking a basket approach and shorting those and kind of knocking out the outliers, but over time they tended to go to zero, but not so much these days. So I would say that in this environment that we're in today, yield is a big component of return. So yes, a capital gain for sure, but waiting for that capital gain can take longer now than it's taken in the past. And so having some yield attached to the security, some form of income to add to the return is an appealing thing.